Stephen Schork is founder and editor of the Schork Report, which provides energy market intelligence. Good to see you again, Stephen. Welcome back to the programme. So everybody did think, didn't they, that oil prices were heading towards $100 a barrel. So what's happened?
Yeah, well, that certainly was the groupthink 1 week ago, which of course, was the end of September, so the end of the third quarter. We had a significant run-up in oil prices going into the end of the quarter as books had to be squared. So now we're starting off the new quarter, and we're in a bit of a correction right now from a significant run-up, as I said last week. The fear now in the market, and this has been the fear, is are we not going to go into recession? And if we are, is it going to be soft or it's going to be hard? I think there finally is a consensus now, regardless of what the U.S. jobs report came out, that yes, interest rates are going to remain high, they're going higher, and they're going to last longer. So now we're talking about U.S. mortgage rates upwards of 8%. So that certainly is causing a fear. My biggest fear with regard to the economy is the U.S. consumer. We just had a report a while back coming out from the San Francisco Federal Reserve Bank that we have eaten over $1.9 trillion of excess savings from the pandemic. So we virtually have no money in the bank, and our credit card debt is over $1 trillion, obviously a record, and the interest to service that credit debt is over 22%. So with the U.S. consumer being 70%, 70 of the U.S. economy, with that consumer squeezed right now, prospects for further economic growth are in question. And hence, I think that fear is taken into the market right now as we look ahead to the final quarter of this year.
So we've seen this a correction, if you like, to the oil price. How do you think OPEC is going to try and manage this? We've already seen them extend their production cuts. So what's their next move?
The next move is, I think they're going to hold the status quo. OPEC, as with any commodity producer, is very wary of the growth or the health of its client, of its consumer. So OPEC is really kind of, and any oil producer, I should say, is really toting a fine line here, that they need prices at a certain level to get a return on investment, of course, but they cannot have prices so high where you choke off demand. So I do think OPEC will maintain the status quo. If we look at the forward curve in pricing, we're in a situation in the commodity markets called a backwardation. That means when we look at prices on a monthly basis, the price for this month is greater than the price for next month and so forth. So there is a premium being charged in the spot market. So what that means is you are inducing barrels to come out of inventory to be sold into this higher market. That is a clear sign of a market that is undersupplied relative to demand. So OPEC consistently watches these forward curves in all global markets. And what they're seeing now is certainly an area where the market does seem to be undersupplied. So I think, yes, they have extended to the end of this year, but going into next year, I think they're going to have to re-examine their approach and look to put more barrels potentially on the market in 2024.
So you think we're undersupplied already? We're, of course, moving towards winter in the Northern Hemisphere when there'll be increased energy demand. How do you think that's going to affect oil and gas markets?
Yeah, absolutely. Good point. We are in what is now called turnaround or the maintenance season. So the major refineries in North America and in Northern Europe, this is when they shut down or they shutter operations as they retool, perform necessary maintenance. So their demand, crude oil demand, is actually at its weakest right now as the refineries temporarily shut in. Once those refineries begin to ramp up production again in November, December, they'll certainly be underpinning price support for the market. And certainly we're not out of the woods with regard to triple-digit oil prices through the end of this year. And so it's all going to remain on the consumer here in the U.S. Of course, the other elephant in the room has been China. Now, the oil bulls for the past year have been counting on growth of demand in China being the one biggest bullish factor in this market. But we're waiting for Godot there because that China demand has not really materialized this year. So if we look for that, and if the U.S. and if the Western economies can avoid recession and China demand does pick up, then yes, given what we're seeing in the forward curve in a market that is undersupplied, we add this demand to the market, and you certainly create a scenario where we could see oil prices into the 100s.
Stephen, good to talk to you. Thank you for joining us today. That's
Thank you, Robin.
Stephen Schork from the Schork Report.